I'm David Yang. Good to meet you guys. I'm a partner at Activent Capital. We are a Series B, C investor in commerce infrastructure, how you make, move, sell, and pay for stuff. Obviously, fintech is a big part of that, particularly embedded finance. So was excited to be up here with these esteemed gentlemen. Maybe let them introduce themselves a little bit and their company. Maybe starting with Gal here, who I believe is a physicist and quantum optics PhD by background. So maybe how did you find your way to embedded finance and fintech more generally?
Yeah, so the story is quite funny. So I did my PhD indeed in quantum physics in a field that's called quantum optics. Finished in 2012, went out to the world. I was working at that time in venture capital in parallel. I said, let's do a quantum computer. And
a little early.
Little early, yeah. 2012 was a little early. So, okay. I think that fintech started to rise in these years. 2013 started to rise, and 2014 we started LendIt, which is now a publicly traded company. We are specialized in point-of-sale lending, both in Europe and in Israel, and we also provide technology to financial institutions, and the spec is quite wide, grown quite significantly in the last few years, and it's a very interesting, I think we are in very interesting times in general, and what's going on in the world today in the world of fintech, and it's, times of change.
And Dan, you are at KeyBank now, but you've got, I think, a long history through financial services, both with large institutions and fund startups. Maybe walk us a little bit through that and a little bit on KeyBank and what they're doing in embedded finance.
Sure. It's a little hard to follow Gal's intro there. So he will take the math questions, everybody.
You are not a PhD.
Dan Williams, I'm with KeyBank. I'm responsible for building out our embedded banking business. I have kind of had an interesting journey to this point. Prior to joining KeyBank about a year ago, I was with a startup called Phoenix Payments. I was there from seed stage through exiting after the B, and we were a payments orchestration layer for card acquiring that helped software companies own their own stack. Prior to that, I managed payments products at Fifth Third Bank, which was and I previously FTPS, which became Vantiv WorldPay. And then I start to date myself. I did a decade at First Data as well. So I've basically spent 25 years where I've done large-scale processor, financial institutions, so regulated entity product development, as well as done kind of the fintech startup. And ultimately, I think over the course of that time, I've fundamentally fallen in love with the problem, which is really around what this could be. So I'm at KeyBank now, and it's really just about building a better embedded finance ecosystem for me.
That's great. I think it's interesting just to, before we dive into this, I think pretty fun topic, the backgrounds here. I guess we've effectively got a fintech and a bank and an investor, and maybe we can make sense of this interesting topic together. So maybe to kick it off, just to sort of level set a bit, guys, how would you define embedded finance? From your vantage point, just so we're all sort of speaking from the same book.
Yeah, I'll start on this one. And I guess the first thing I'll say is, regardless of how I define it now, whoever you're talking to about it, you better figure out how they define it, because it has taken on a lot of different meanings depending on the audience. But fundamentally, if you look at finance, you're really talking about financial services. So that could be, for some folks here, it could be lending, which is, one segment, but it's also payments, and it could be depository accounts, like the fundamental money movement in and out, so working capital, loans, balances. And the question is, like, those are traditionally associated with, financial institutions if you were to go way back, but when you talk about embedded finance, it's really about what are those services embedded in? And they're fundamentally inside of software, inside of workflows, inside of affinity-based technology experiences. So it's really looking at, okay, how, if you go out to the ultimate consumer, either the business or individual getting financial services, what is the fundamental thing that they're interacting with? And embedded finance is some sort of workflow. And everything else ultimately serves that to serve that consumer.
Yeah, so taking on that, I think that there is a certain line between embedded finance and technology or a SaaS solution. There are many companies who provide technology for financial institutions and other companies, and I don't think this is really embedded finance. This is providing technological solutions. I think that embedded finance is to take the next step. Is not just to provide the technology, but really to provide the full needed solution for the enterprise, for the bank, or even a bank can be an embedded finance solution provider. For instance, if you're a lending company and you want to be embedded finance solution provider to a limo company, you should hold the license, you should provide the lending, you should manage the consumers. But I think that embedded finance now works mainly actually between fintechs and financial institutions. And it's funny because financial institutions in general are supposedly not needed to have these embedded finance solutions. But if we look at banks, credit union, etc., this ability to reinvent yourself, to provide products that will allow better reach to the customers is very difficult and it's very out of the DNA. And here you need these embedded solutions. We did something like that with a very large bank in Israel on point of sale lending, that we developed a joint venture together with them that in 1.5 years became the market leader and actually is now dominating completely the market. There are a lot of advantages in working together between fintechs and banks, and I think there sits the embedded solution either for lending, payments, or even trading.
Yeah. And I think like in general on this, like examples are really helpful. So like a very basic B2B example might be you're a healthcare practice, right? And if you were to go back 10 years ago, you would have bought, your practice management software that you did your scheduling with and manage your patient base and potentially your revenue management cycle and claims. And then you may have had secondary relationships with, someone that helped with payments or a banking local depository institution. When you go in that example now, you basically say, okay, your practice management system is the first thing the practice purchases because it's how they're going to run their business, but inside of it now is also how they accept consumer directed, HSA cards. Inside of it might be their payroll. If they have a large capital expense, they may go to their practice management software provider and say, what do you have? When that practice management software becomes the distribution point and the acquisition point for that affinity that's specialized to buy it, that's an example of embedded finance.
Yeah. I think that's a great way to sum it up, great way to think about it. I liked what you said in there, particularly, Dan, about the workflow. A digital workflow that comes across as a native experience to the end customer or end business. At least from the, that end customer and merchant's perspective, it's a seamless, easy experience. It enhances their, their journey and deepens their loyalty with said customer. Obviously, that's sort of the tip of the iceberg. There's a lot of fun stuff below it that you guys have both alluded to as it relates to embedded finance. Maybe we can unpack some of that. How would you? Yeah, let's start with. Since we're talking about value and marketplace, the vision and potential here, guys, with embedded finance from your perspective, and that could be a nice dovetail a little bit to where the value will be created and who's going to capture that.
Yeah, so that I think is a great question because in general, value is where you create stickiness. Where you bring your client and make your client stay and you have recurring sales with your clients. This what's creative value because otherwise, you do some marketing, get clients and they run away. So if we look at embedded finance and we look where the value will be created, I think it will be created with direct interaction with the clients themselves or with the businesses themselves, and will create the generation of capital for that. And if I look now at in a wider scale, a bit like 10,000 feet above, and let's look at the world today. How many banks and credit unions there are in the US today?
Tens of thousands.
Tens of thousands.
or thousands, sorry, thousands.
How many of them provide the needed solution for the Gen Z?
Yeah, not many.
Not many, right? Okay. And on the other hand, what most of them got? A lot of capital. If you look at them, they have tons of capital inside, but they don't provide the right solutions. So in my perspective, there is this, and we spoke of it, there is this 3 pillars theory. That it means that in any financial institutions, you have this distribution. This is one pillar, the distribution, marketing, the go-to-market, the front end. The second one is the management of the client, the management of the risk, the management of the loan, the payment, whatever. And the third one is the capital. You cannot win them all. And these tens of thousands of financial institutions and banks in the US hold very seriously the third pillar. But the first two, a bit less. And here I think there will be the connection between this would be the big change that will create embedded lending or embedded payment. It will provide these institutions the ability to live another day, and to grow and to continue to provide services that will be effective and relevant to Gen Y, Gen Z, and their next customers.
There's parts of that I definitely agree with, and there's parts that I'm in a little bit of a different position on. And I think I absolutely agree with the way you compartmentalize like the value, right? Like there's different roles of that. And there's the generational thing, but like some of this is just looking towards the future. And it's irrespective of generational because it impacts B2B, and it's fundamentally just like if we all look to the future, it's different than right now. Like we are just getting started on this. Yeah. And I think like just to give you some examples, in the US, I think the CAGR on this, and this is citing like a Bain study, was I think it's a 19% CAGR, but we're still only on a $2.6 trillion industry, but it still only represents 5%, yep. Right? And so, okay, we're in this state of just getting started, and you say like, what does the future look like and where is the value going to be created? So the first thing, if you look at the future, it's fundamentally, like, I think the analogy is it's got to work more like electricity, right? Like it's just there. Financial services are fundamental infrastructure. They shouldn't be complex. Like you should be able to access them, consume them. Platforms should be able to access, consume, and ultimately distribute them very easily. And it's not if the rate of change of technology, the specialization of technology is fundamentally accelerated faster than the ecosystem's ability to open up to that. So there's a big just like, let's make this more like electricity at the core of the system. Let's make sure, and then on the endpoints of the system, let's make it very specific and poignant. And if you look at like, and you think about like the fundamental value that we all have to create in that, right? You have to create efficiency for the business, right? So this could be if, and I think this is what makes certain platforms more successful than others. So the efficiency could be how they operate. It could be like how they reconcile. It could, so that's just one place. Better business operations by tighter coupling of what their money's for. And that they've created a lamp that plugs into this electricity, and together you've lit up a room, so to speak. The other big value creation is fundamentally like fraud and security, right? Like it is a huge problem still. There are a tremendous amount of bad actors, right? It's banks absorb losses, customers absorb losses, everyone, so fundamentally securing it is another huge place where value can be created. Massive dollars go out to bad actors, right? And then I would say another big area is like we don't talk about a lot is just inclusion, right? Like there's still large swaths that fundamentally could access financial services that they can't today. So that grows the overall market size. And then velocity, if you just look at the speed of commerce, the acceleration, microtransactions, this is a growing pie, like fundamentally. So there's value to be created on all of those.
The four, you would say efficiency, you would say fraud, you would say inclusion, you'd say velocity, sort of.
Yeah.
The buckets of value.
The last two ultimately growing the size of the pie, and the first two fundamentally making what we do today better.
Yeah. Yes. And I'll try to explain to a bank to use cybersecurity tools with his clients to prevent fraud. It's not there. And it's need to have these fintech partners that knows how to do that, to bring these cybersecurity tools to prevent the fraud, actually to eliminate it. And that's the point that it becomes really fun, actually.
Mm-hmm. Mm-hmm. Well, I guess in the ideal, I like the 3-pillar framework, right? If I could put sort of, let's say financial institution, fintech, and distribution partner, workflow, the product, consumer-facing product distribution is a good way to think about it. Obviously, in an ideal world, all these levers of value creation, everybody wins because it's a bigger and bigger pie.
Yeah.
How do you think about situations where there might be, a little more, zero-sum game, or where you have to trade off, or where your value creation might come at the expense of another partner? Where are some of those maybe obstacles to, seeing this, vision of embedded finance really growing the pie?
Yeah, I think.
Where is there misalignment? Where is there?
Let's look, for me, it's always easy to go to the world of lending. So in my point of view, unsecured lending is going to change completely, for instance. Like, I think that the solutions at the point of sale, a real point of sale lending, not the BNPL of small purchases, but the large purchases of thousands of dollars is going to take over unsecured loans almost completely, because it's give the right solution with the right amount, with the right timing, with the ability to manage the cash flow properly.
At the point of sale.
At the point of
workflow,
sale. Yeah, whether it's e-commerce or in-store. That's what we are doing, for instance. And I can tell you that we work, for instance, we have a joint venture with the largest bank in Israel. We built a joint company. They do the third pillar. They provide all the financing. We do the first two pillars, in our case. And where does the friction come from? The other departments in the banks that, you actually might reduce the ability to lend because, wait, these guys are the future. And what we do in the retail department, we're the past. So, and this creates a friction. The pie will grow, for sure. So we'll take over more clients. They will take over clients of other banks. But the retail department, a bit.
Dan, how do you think about that? How do you manage that maybe internally at a financial institution?
There will always be sort of like people that are vestiges of like trying to hold on to what it is, but like that never carries the day. At the end of the day, like the way I think about this is like, if you are truly oriented to a customer and a customer experience, and you will fundamentally see what is at the heart of all this, which is a better together value proposition. And in that, like, it becomes easy, right? Like, it's easy to be inside of a client's ERP system. Yeah, there may be misalignment to a bank's credit appetite to all the customers of a platform, and that may feel like artificial tension. But like, and there may be and let me say this: like, I don't think like I think most banks are conceptually there on this is important. I think there is a genuine, real challenge in how to execute right? And some of that is just having the right people, right talent, right healthy perspective. And for us, it's been about like, hey, we're creating a bank-owned fintech. Like we've looked at our operating model for this segment. We look at our products, we look at our third parties. But like it's more about evolution and speed of evolution. And so that's not the friction point. The friction point is all execution and fundamentally a model that's user experience oriented, that people may fundamentally be on software in a position to engage clients because they already have their eyes, are in a position to be knowledgeable, fundamentally have more data, but not really balance sheet or money movement experts, right? And there on the other side, you may have like balance sheet, money movement experts that are used to a lending relationship with adjacent services that don't think about user experience. Yeah, there's tension in that, there's evolution in that, but that's just us getting better as an industry. And those of us who get better at it are gonna take market share because this fundamentally is how financial services are delivered.
Other obstacles either of you guys see as it relates to the continued adoption of embedded finance? You've said a few, Gal, you've mentioned one as well. Like other things wrong with the ecosystem that we need to wrap our heads around, other things slowing down adoption?
I'd say if I had to look at pain points, more or less, like one is it's still too hard to be a fintech, right? You probably have 9 to 12 different business partners. You have a lot of partners for a particular thing, like, oh, I can do card acquiring. I'll talk to someone who was at the show I met. Oh, I'm going to do this other thing. I'm going to talk to another provider. And so you have a lot of sort of complexity to manage that is a lot of intermediaries. Working capital is fundamentally inefficient, right? Like a lot of banks, a lot of the back end is very far removed, and as a result, the money's tied up longer. So organizations that are small with a high cost of capital are fundamentally bearing that cost. That's inefficient, right? So there's just speeding up the flow of money is broken right now. And then the last one, which is one we don't talk about, is service. So if you were to go read like Straw Hacker, Sellent, if you just go down and you read and you like stop, thinking about a lot of the stuff we talk about here, and you're like, what do these customers say they want? What they fundamentally are crying out for is a better service model. Yep. And what's happened is the number of intermediaries, the number of this, the removal of backend, there's all these black boxes, right? Where, oh, it's an API and it's all happy path when you're boarding. Yeah, we can do it in minutes, you're on. Well, that's like one moment of a multi-year relationship. And in financial services, it's always the exceptions that get you. It's when something doesn't go right and the money has to be there, it has to balance. That part of this equation is too big of a black box. So that's the last part we really need to do a lot better, which is we brought money movement forward. We have to bring the whole experience forward.
Yeah, I want to take it also to a bit different direction. Is when you start a fintech company, you have a problem. So you see the problem, you see the pain, you want to bring the solution. And the solution means that you need to develop a product around it, but then you need to acquire the customers, which is a very expensive, like to build their unit economic right, but still until you get to the right product market fit and stuff. And then there is another layer of complexity because we're in the financial business, and in the financial business, then you need to have a lot of capital. And this capital is super expensive. Like in lending, I think it's the most expensive. In payments also, you need a certain amount of capital in order to do the payments as well. And you find out that in order to build a business that will be profitable, that will be good, that will continue to grow, you need massive amounts of capital. And then you get kind of stuck. And I think that embedded finance create this solution because you can create These partnerships are not coming from nothing. This embedded finance didn't came because someone thought that it's a nice idea. It came from a true pain. And the true pain is that when you are a startup and you want to continue and you have a great product and you're growing and you want to continue the growth, it's not a SaaS. It's not that you can sell 1 million more. No, you need equity, and this equity needs to grow and grow and grow, and this equity dilutes you. So what you do? You partner with someone that has this equity in massive amounts, and you provide something else to the table. And these partnerships is what create this embedded finance, and these partnerships is what allow us to grow and to make really companies that will be big and successful and profitable, and to build up this system correctly.
I was going to wait to ask this question, but just you got me thinking, given where we are in the kind of the current environment, rising rates, so cost of debt capital, cost of equity capital, how does that change maybe who stands to benefit or benefit more, capture more of the value in embedded finance between those three pillars?
So,
are banks just well-positioned, people who hold capital are even better off now than before? Or it's not as simple as that?
think about piping. I see it as I have, I imagine things. So I think it's like piping, and there is the waters that go through the pipe. Who sits the closer to the pipe gets more money. So if you look at, for instance, a startup that does lending, who gets the most amount of money? The debt funds that provide him the capital. And it can work. Like, let's say that the debt fund now in the US will charge between 8 to 12%. Sure. Okay? The clients will pay about 17%, minus NPLs, minus that. What the startup will stay with 2%. The debt did 3 times more than him or 5 times more than him.
Yeah, and to me, that's one of those topics that, like embedded finance is even when we defined it at the beginning, it's a very broad category. And I do think certain entry points, I think if you really get into the lending game, like you are, right, that's a whole nother sub-industry of sorts, right? Because, it is the most capital intensive, and it's the most, it's a fundamentally risk intelligent customer acquisition centered business. There's other cases where and it's interesting that if you look at the US, most of the largest, kind of known success stories, and you could throw Square and Stripe. If you went back, you could throw in Shopify, Lightspeed. A lot of them actually started with payments.
Yeah.
Because they could fundamentally move money, find someone that can move it, and they could again acquire the transaction. In exchange for acquiring the transaction, and learning to growing up to manage the risk, they could fundamentally drive that. It's now they're trying to make that jump to be holistic financial service providers, and I do think it's pressure on it. But ultimately in this value chain, everyone's going to get, this is a new value chain, right? A growing value chain, and the platforms that acquire the customers and help with operational efficiency fundamentally get to charge more for their software, and they can increase their total TAM or target addressable market in their long-term value of clients while holding their customer acquisition costs relatively flat. That's why there's a big push into this. It's why it drives their valuation up. And traditional folks who would distribute through feet on the street now are like, yeah, great. Part of our unit economics go that way, and let's just work through this new model. It's, we have to figure out third-party risk management, there's education, there's compliance, there's a journey to go through together, but you're fundamentally able to, I think I'm an optimist. I go back, there's plenty to go around in terms of value, but ultimately, if you're the source of liquidity, you're gonna get paid for your risk on the back end.
Yeah.
You're alluding to it as well, Dan. I guess from maybe it's KeyBank's point of view, or take the step, take a step back and sort of a more generic, let's say, bank's point of view as it relates to embedded finance. Are there, I don't know, certain products, certain demos, certain things that you're more interested in? Maybe embedded payments versus lending, or ... How do you think about what's more interesting, what's less interesting? How do you guys choose a partner? There's a lot of questions thrown in there, but give us a little bit of the bank's perspective as it relates to potential embedded finance partners.
Yeah, so I'll say this to the hardy crew here that's left. Like, if you generally are trying to explain this to anyone in a financial institution, I made the mistake for years as trying to explain it as technology, when you really need to explain it as distribution, right? This is just a fundamentally different distribution model for your services. And then we start to look at like what needs to happen for us to distribute services this way. And we do have to sequence that, and for us, payments is a big piece of it. Fundamentally, deposits are important to us. So the idea of this whole, what's different is there's a whole complex hierarchy you have to manage of partners involved in this that wasn't traditionally there. So the idea of sub-accounting, like we provide FBOs, operating accounts, people can manage sub-accounts underneath it, is huge. For us, of all of them, the hardest one has been lending. Yep. And the reason lending's been hardest is, and that's the one we're probably doing last, maybe we can do short-term, like work cash flow based type of stuff with how efficient we are. But the hard part about lending is we fundamentally have a risk appetite in a type of person we want to lend to, and a platform fundamentally wants to support all of its users, right? And those are different, right? So that's where folks like Blender come in and say like, hey, we're going to manage the platform's user base, and we're going to have people behind us that may have different risk appetites.
Actually, what we understood that it's not enough. If you're a startup and you want to grow fast, and you put your money on the risk appetite of the financial institutions that work with you, you cannot grow. So what you need to do is that if you believe in your models, if you believe in your technology, and you need to take the risk. And that's what we're doing. And then when you take the risk, it's become easier for everyone to kind of.
And you
understand what?
It's interesting when I think that's correct. The other thing I think technology companies can fundamentally do, like it's perceived as more risk, but like there's also just being more precise.
Exactly.
Right? So we bought Laurel Road. It's a national healthcare-based affinity brand. And like when you look at it, like if you fundamentally have more data, you're more in tune with the business, and you're specialized, you can just be more precise. And so it's not always about more risk or not. Sometimes it's about like being precise in what you're targeting and knowledgeable of it, and then not being a generalist. So it looks like you're taking on more risk, but you're really just carving out a niche you understand better.
Yeah, I think the technology in many places, especially in fraud prevention, really it creates a true solution. The KYC processes are much better, much faster. We underwrite a new client in 17 seconds. Not just underwrite, provide the loan, like closing the cycle. And it's a new client that we just met over the e-commerce or in store, and we had no previous data on him, and fraud is almost completely eliminated. And default rates are extremely low, because this is the technology. This is the secret sauce that can be created, and this works over 5 different countries. So you cannot say, this is one market that is like that. And I think that technology, as you said, allows us to work much faster, better, more precisely. And it's always easier for the old financial institutions to say, no, listen, you need to work slowly with a lot of manpower and stuff. But wait, when you get to these volumes of so many clients and so many processes in a given minute, it needs to be automated. And if it's not automated, you get much more problems.
Yeah, and if you like look at the segments like consumer lending, consumer like purchase, like some of the things like one segment absolutely got to like it's speed, ease of use, and then you start to get to small business. Now small business, we've seen a general, it's a part of our book where we see the benefit of working with specialized platforms like healthcare platforms and others to, work with to work in that segment. And then as you start to move up market, like a $100 million revenue company is different than a Fortune 5, and so it's like you may have one entire business model focused on large corporates that is different than a business model where you're partnering with technology companies to deliver better services to small businesses, consumers. But I completely agree that like no matter what, like we will invest in, like I have to choose where our technology dollars go, right? Yeah. And I have to choose really wisely when we're going to develop software where. And there's no way I can develop software for every scenario. So we absolutely partner and we'll absolutely power. And it is integral because that's where precision comes from, that's where specialization comes from. And if you're grounded in what the end consumer needs, it fundamentally it's better when it all works seamlessly.
Maybe to pull a little bit of it together, Gal, I am, this partnership with your bank, I think sounds like a good example of a successful embedded finance partnership. Specific advice or learnings you might have for other fintechs as they navigate their bank partners, and or advice for banks as they navigate their fintech partners.
Yeah, so I think that the first thing is that when you work with a financial institution like a large bank, it takes huge amount of time to finalize the deal, and then to get the regulation sorted, and then to get all the approvals and everything. And if you will wait, as a fintech, if you will wait to get all that sorted to start to work, you will find yourself waiting. The average time, I just recently read the research that the average time for a deal between a fintech and a bank is 1.5 years. But this is average. It means that there are ones that takes 2 years and the others that take 2.5 years even. So you cannot wait. You need to start working. So you need to have your foundations need to start to work and build the clientele base, start to create revenues for you as a company. And even if the ultimate goal of this activity is to create this partnership, you cannot be dependent on that. So this is my first advice. Second advice is that once you work in parallel, you have the patience. You have the patience to close, because in the other side it takes a long time. And the third advice is trust no one. Kind of. Financial institutions.
And on that, we'll close.
That'd be a great way to finish.
And especially not, you go to these financial institutions, they're huge, they have millions of customers, and they tell you, yeah, we use our distribution channel to sell your product. Yeah, sure.
Maybe Dan, last, we're in the minute we have left here. Any advice you would have for, said fintech partner or distribution partner looking to work with a?
I have worked with fintechs as a bank. I've worked with them independently. I've been one, and I would say the last thing, in general, there's this false narrative we have of, okay, speed, agility versus, compliance. And to me, they're two sides of the same coin when it comes to money movement. And you just have to go into this knowing that it is a little different to work with money, right? Like watch a Netflix series, there's bad actors, there's a reason these things exist. And you fundamentally have to go in okay, you know what, my investors will value me demonstrating operating maturity in this. So you start to get into compliance, you get into all these things, understand why they're there. And the other one is pick a partner who gets you, right, is the other one, because not everyone gets you. So you kind of got to do that, you find a good partner, someone that's going to help you through this, but it's not just, understand the reasons why some of these processes exist in that they're like fundamentally people will, if you have money, people will try to rob you. Like that's a thing. Like so you gotta like think about this. You gotta secure, you gotta do these extra things. And it's okay. Like it's a good thing. It's stability, it's growth, it's maturity. And so you just balance the speed of the slickest UX with the sustainability on up. And if you go into it with that attitude and you pick a good partner, and you focus on the experience you're creating and your value add in this, and not doing it because the board told you, you can absolutely be successful.
Yeah, and
All right.
And to sum up, I think that we are in a really unique point in time, and many of the financial institutions need to decide whether they want to be Netflix or Blockbuster.
Okay.
And they can do these steps, they can do this hope to the right access to their customers, but they cannot do it alone. And there I think the place that embedded finance is getting into the game and provide these solutions that allows them to become Netflix and not to.
All right, that's a good way to finish. Thank you guys. I appreciate you guys spending the time.
Thank you, David.
Thank you to the audience for sticking around, and we'll see you guys at, I guess, the drinks.
Thank you, everybody. Appreciate it.
Thank you. See you.